Today's episode of Market Talk is brought to you by Growmark FS. Keeping up on the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. Well, as we wrapped up the first week of trading on Friday for 2023, we saw a bit of a rebound, especially in that soy complex. A strong day there. Mixed action in corn and wheat, down day in livestock, rebound in the outside markets. But we have just a lot going on right now in the market trade here as we get set for the January WASDE report coming up next week and more. Let's dive into the week of trade that we saw this first week of 2023. Joining us today, our good friend Ted Seifried, Saner Ag Hedges, with us. Ted, good to have you back on the show, buddy. Happy New Year to you. Hope you're doing well.
Yeah, Happy New Year's, Jesse. I'm doing great. I hope you're doing well too.
I'm doing good. And, I hadn't been, I've been doing better than the markets for most of this past week. But then Friday we come back in. Decent little recovery day, especially in that soy complex. But man, Ted, this has just been overall been kind of a rough week for commodities to start off the new year. And I know there's been a lot of longs getting out of the markets here and there. There's just been a lot swirling around this commodity trade, Ted.
Yeah, absolutely. You're right. We had fund liquidation really to start off the year, and it wasn't low volume holiday trade like we had seen for the last 2 weeks. It was some pretty high volume. So these were some very decisive trades, really. I mean, we were under a lot of pressure. And then, typically after 3 days of fund liquidation, a lot of times they will take a bit of a break. That's when your dip buyers come in, or whoever has been selling it in the last few days, taking a little bit of profits on a Friday in front of a weekend where we're still trading a weather market. We still have Argentinian forecasts that we're kind of hanging on every day. And that did benefit the market on Friday with the Argentinian forecast getting a little bit drier as well. So yeah, beans found some strength. They took back a good portion, almost about half of the losses for the week, but still a pretty big down week, and not a really good look on a chart for a weekly chart. Although we did scratch out a hold of that weekly trend line, which again is kind of what was one of the things that was encouraging those dip buyers. But we'll see what happens next week. I'm going to say that this week feels a lot different than what we've been doing for the past roughly 6 months, Jesse, where you have a big down day, or maybe even a big down day, and then another day where we're down just a little bit. And then on that second or third day, you completely reverse that and take back all the losses. You've had a lot of sell signals in the last few months or so that get immediately negated, and you've had some buy signals that get immediately negated too. It's just been again very sideways trade for corn and soybeans in particular, with again technical signals just kind of not meaning a whole lot. Mm-hmm. But this week we had that big sell signal that happened on Tuesday when the markets reopened, and then you did follow through. And you had that 3-day fund liquidation in both corn and soybeans, and wheat really doesn't look good either. So if this week has any indication of what's to come over the course of the next few weeks, you feel like we are going to get into some a little bit more directional trade rather than sideways trade. Which way that direction is, I guess, we've been talking about Argentinian weather, South America. There's a lot of things going on. But I don't know, it really does feel like down might be the way. And it's not necessarily because of what's happening in the soybean market individually or the corn market individually. Although I'm going to say corn export sales continue to really, really be a problem. Mm-hmm. But this was more macro. This was more of a risk off, money managers not wanting to really feel super invested in commodities. Maybe that's sort of the inflation off trade that we've been talking about as well, or at least not as worried about inflation going forward. More concern about global demand, more concern about China, a lot of COVID issues there. They've moved away from their zero COVID policy, which we were looking at as a good thing. Like, hey, that more demand coming in. But then you see this another big wave of COVID happening in China. A lot of Chinese self quarantining. EU moving to put restrictions on Chinese travel or COVID travel bans, things like that. China's not happy about that, and so yes, now we have a whole lot of concerns about that. And I think the managed money really expressed those concerns the first 3 days of the trade week, Tuesday, Wednesday, Thursday, and then again took a pause on Friday, and that allowed those dip buyers to come in. So we'll see where we go. USDA report, big USDA report next week. That may usually has a pretty big impact on markets. This year it may or may not, Jesse. And that I say that because, like I said, sometimes we're trading grain fundamentals, sometimes we're trading macro fundamentals. And if we're trading macro fundamentals at the time, that report might only be good for a day or two. So we'll have to see what happens there. We haven't seen report estimates yet. I mean, I've submitted mine last night. I haven't seen the average trade guesses yet. I think those will come out this afternoon. Personally, I'm not really looking for a decidedly bullish or bearish report.
Sure.
I think you're going to have a little bit of both. But, I'm curious to see what the average trade guesses are.
Well, and to your point, that January report usually very, very big report, very big market mover. But I like how you frame that up is the fact that, if we're trading macro fundamentals, it may not matter. It would probably just be a instantly kind of trade it for a few minutes and then we forget it kind of thing. So I think that it's going to be a great point and interesting setup to next week just to see how the market is acting heading into that report on Thursday, Ted.
Yeah. So here's the thing, Jesse. If we get a report that's bullish, like let's say they cut, because remember last September they cut production on corn and beans, sort of atypically. Usually they wait till the October report, but they felt like they had enough data in September to do that. And let's say that trend continues and they cut production more than again, I'm going to say what the trade's expecting. I don't know what that is yet, but let's say they cut production more than what our expectations are, whatever our expectations are. Let's say our balance sheets are tighter than expected, and you get this knee-jerk bullish reaction, but then they start selling into it. And if we get a bullish report and can't have a really solid close that day, and then again follow through the next day or two, that's a really big warning sign. That's a really big red flag to say that, okay, now we are getting bullish information in this market and they're selling into it anyways. So now it's not about the individual market fundamentals. They're looking for sell opportunities. They're looking to sell strength. That's bad news. We need to get priced. We need to get priced for a long time, as far out as we can. Because the fact of the matter, Jesse, is that we are trading at some historically high prices. This is the highest price soybeans have ever come into a new calendar year, right? You have to respect that. It takes a whole lot of bullish news to keep markets rallying. It takes a whole lot of bullish fundamentals to keep markets up near not all-time highs, but we're certainly on the highest end of the historical range. It takes a lot. And at some point we might have a situation where we still have a fairly bullish fundamental outlook. It's just not getting more bullish. And you look at the price ranges that we would normally be trading in, and you got to say we're not only on the higher end of that, but probably above that range. So you could get a sell-off, even though fundamentals aren't getting tremendously more bearish or less bullish. They're just not getting more bullish. And again, you look at that South American crop, soybean crop about to come online. You got to say, ooh, our export sales time for beans might be really very limited at this point. Yep. At some point, that shoe will drop. It's just a question of when. And we've gone for 6 months with a very indecisive market. With a slight lower bias in corn and a slight higher bias in beans. But at some point, we will break out of this massive level of consolidation up at very high prices, and we will go one way or the other. And I got to say, the odds are on down. Not to say that we couldn't have one more hurrah to the upside, but the clock is sort of ticking on that for South American weather. If that's not going to be what's do it, I'm not sure what would. And then you say, okay, well, $12 beans, is that more reasonable? Or, 5.25 corn. And if that's the case, those are still good prices, but keep in mind, we've paid a lot for inputs for corn in particular. This is the most expensive crop we've ever grown. And
Yeah.
you've got rates coming up, so there's a lot of risk out there if these prices go away. And so you got to be cognizant of that. And I really think you got to be doing things to protect that.
Ted Seifried, Zaner Ag Hedge, is our guest here today. Ted, another thought I saw as well on Friday that I think is just an interesting note, possibly the strength of this bean meal market. We've talked about it, printing over $500 in that January contract. I know it's a delivery, but still, that's wild to me, Ted.
Yeah, no, meal's been very strong. And then on, Friday, the meal was certainly the leader. January contract in particular. But even when you go out to the May, up $9 or so, that is a really good day for meal. There's demand for meal. I mean, that a lot of times we'll get rallies in soybeans, and even if we have a balance sheet that's not especially tight, and as of right now, the last balance sheet we saw was a fairly tight balance sheet for soybeans. But even we will get what I call a meal deal, right? Where we'll get tightness in the meal market, meal will take off. That's encouraging the crush to expand, although we can't really just do that on a drop of a dime. So that meal can really make its presence known. And so it's interesting to see what meal has been doing here. Whether it's able to continue on, I'm not sure. We talk a lot about the animals that we have out there. And we just recently had a lot of weather issues. We've seen hog weights up sharply, up over 6 pounds in the last week, which means we're starting to back up on supply. And that's a big reason why the hog market's kind of fallen very sharply this week. But if we start to back up on supply, then the question is, okay, what are our needs going to be for feed? And you think about poultry, and if we're backing up on pork supply, which is the most direct competitor to poultry, do we really need to continue to push that at high levels? And then for cattle, which is more of a corn thing, but for cattle, we already know that we're going to see our production drop pretty dramatically through the first 3 quarters of next year. So then you really wonder, okay, are these higher prices in meal, is that ultimately going to be rationing some demand, which actually might already be rationing itself? So, it's great to see that strength in the meal, Jesse. But you wonder how long that can last and how long that will be a driving factor for the soybeans.
Very, very true. Well, you mentioned the hog market. I want to move there. You hit it on the head. Well, I don't know if we really want to talk about it or not, but man, rough week at hogs, Ted. And I know you and I were chatting before we went on the air, just how ugly the charts are starting to look. And hogs, I think we need to maybe wave a warning flag here a little bit.
Yeah. This week, and it actually even started at the end of last week, before the New Year's holiday. This looks like what we did in the middle of September when we had just a massive fund liquidation. We were able to find some footing and bounce back eventually, but yeah, this doesn't look good. 2 things going on in the hog market. We had that weather, and that meant that it kept some hogs from going to market, kept them on feed longer. We saw that big gain in weights. But most importantly, what we didn't see was a big jump in the pork cutout values when marketing slowed fairly dramatically. And so that was disappointing. It's kind of a telling sign that maybe that domestic retail demand isn't very hot and heavy right now. And then on top of that, Friday morning, because of the delayed export sales, weekly export sales, you have a massive cancellation, massive cancellation. And the big culprit, and it wasn't just Mexico, but the big culprit being Mexico, that's our number one trade partner for pork. That's not good. And you wonder if there were some market participants, probably were, that knew about that earlier in the week, which was part of the reason why we had that sell-off. So maybe the last 5 or 6 sessions, this big precipitous fall off that we've seen in hogs, maybe that's coming to an end. But man, it's just been a free fall. And there's been some rather negative fundamentals that have kind of factored into that. So now we're stuck with the idea that, pork cutouts were down pretty sharply this week. We've got a fair amount of upfront supply. That domestic demand is a little bit questionable. Our export demand is now really very questionable. Right? And
Mhm.
minimally, that Fed contract has a gap in the chart down just above 79. I think we'll have enough momentum to go and fill that gap. But I'm wondering if we can fill that gap, maybe we can find some footing and try to bounce back. And you wonder if that range that we set between mid-September and the first couple trading days of October, maybe we continue to wildly chop within that range. But if you break 76 in Fed hogs, you got a big problem.
On the cattle side, I know cash trade's been taking its sweet time this week to really get anything going. And then just in general, a lot of folks still have their bullhorns on in this cattle market as we move into 2023. Do you have yours on? What are your thoughts with what you're seeing in cattle right now, Ted?
I think when we talk about cattle, you got to really take a big step back and look at the bigger picture, because ultimately that's what's going to determine the prices of beef and of cattle. Because we know what's kind of occurring on the supply side, and that's been something that we've talked about for a really long time, and it's been factored in the market, over that time, right? We know that there's going to be a pretty significant drop off in production throughout the first 3 quarters of next year, minimally, right? So that's why we're up, at some higher levels or near the highs in the cattle market. Domestic demand has, to this point, been really rather good. You've got especially the select cuts, at the highest levels they've been since, right before the Christmas holiday, which is a big buying period, right? It's a big demand period. So
Mhm.
that's good to see. But then what happens, like I said, broader picture, if we are to see a bigger sell-off in the stock market, we do slip into this sort of global recession that everybody's talking about. And if that is the case, then you do worry about that domestic demand really starting to tail off. And if that domestic demand starts to tail off, even with the shorter supply, that means that we're trading at higher prices. Because right now, the market is assuming that we know that demand or that production's falling off, but we're assuming that demand is going to be there. If there's a question on demand, then we'll have to readjust the paradigm again. So uh, cattle you're gonna have to look at a real broad picture, I think, for cattle for a little while. You also got to track that supply, because what happens if those the supply or the drop in supply, the drop in
Mhm.
animals that we believe is going to be there. Well, what if it's not quite to the extent that the market's factored in? So that is something I kind of don't think that's going to be the case. Again, I think the
Mhm.
demand is going to be the biggest question mark for cattle going forward. Right now, it looks good, but if you have a bigger problem with domestic or global economies, things like that, if people get afraid of spending money, then they won't be buying. They won't be spending up for those pricier cuts of meat, and then then we're too high.
We got just a couple minutes. Crude oil around $74 a barrel. It's been an interesting week on the crude side. Any thoughts there, Ted?
Yeah, crude was what really kind of started the whole risk off, or was the first telltale sign of the risk off when we got into this first week of the new year. But then it really did find some footing towards the end of the week. Um, I'm glad you brought it up. I'm glad you brought up crude, because I'm going to tie this back into the grains here real quick. The crude fundamentals, I'm going to say, aren't terribly less bullish than what they were when we were up near our highs, or even like when we were up near 120. Now we're trading 74, 75 in crude oil. So, what's changed? And a lot of that is the idea that, we've gone from a very hot period of inflation to we still have inflation. It's just cooled off pretty dramatically compared to what it was, at least by the numbers that were given by the government. And you say, okay, well, we've completely decimated or depleted our strategic oil reserve. At some point, the U.S. government is going to need to fill that back up. So these should all be reasons why we're going higher, yet we're not. But then you say, well, crude is really actually trading towards the higher end of its normal range. Normal range, in my opinion, is between $45 and $75, and we're at the high end of that. So you say, well, we are in a bullish scenario for crude, and therefore we're at the higher end of the range. So that makes sense. Maybe it doesn't justify 120 or 140, right? So I want to use that to parallel to the grains markets. And you say, okay, the balance sheets that we have in front of us, at least what we saw back in December, again, we're going to get a big update on that next week, but the balance sheets that we have in front of us are really fairly bullish for corn and soybeans. But do they mean we should be at, the historically high end of the range, or should they just be at the high end of the normal range, which I'm going to say for beans, the high end of that range is in 1250 sort of area. For corn, let's call it 5.25, 550. And if that's the case, then there's a lot of this extra premium in the market that might need to come out at some point. So we've seen it happen in crude. We haven't really seen it happen to the same extent in grains. And I think a lot of that has been weather related because we had the late season dryness that happened, for our growing season. And then, follow that up with some Argentinian issues. And so that's kept that from happening. But again, if you have a situation where the fundamentals aren't getting more bullish, kind of like what happened in crude, you could see a pretty precipitous drop in the market and something that maybe not everybody understands. So again, I wonder if crude ultimately might be a roadmap for what happens in the grains. We shall see. Personally, I think crude has some room to bounce, but it doesn't really act that way. We might not get a good run in crude until the government does step in and start refilling that strategic oil reserve. And we've already violated some of the prices that they said they would start doing that at. So, and they haven't. So that's a big question mark.
Well, we'll wrap up our conversation on that note. Ted, if folks want to reach out to you, get some advice there at Zaner, what's the best way to get a hold of you?
Yeah, absolutely, Jesse. You can reach me directly at 312-277-0113. You can find us on the web at www.zaner.com. You can sign up for our newsletter or read more about us. And then also I'm on the Twitters at the Ted Spread.
We appreciate the time, buddy. Thanks so much for joining us with that. Ted Seifried. See, that you got me thinking about your Twitter now. I'm gonna have
right?
It does work. Ted Seifried, Zaner Ag Hedge, our guest today. Thanks for joining me. Have a great weekend, buddy. We'll talk to you again soon.
Thanks for having me, Jesse. Yep, we'll talk soon. You have a great weekend too.
That's gonna do it for Market Talk today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.